depending on the questions. Okay. So what I'll maybe do is say, okay, let's break now for some questions. That gives people who, want to go for a break. What do you think about that?
Yeah, that sounds good.
No, we don't mind. Just see. I'm going to mute myself. I'm probably going to get calls and everyone who's struggling.
I'm also going to mute for the time being, and I'll take the picture off for a moment. And we'll come back in a few minutes.
Well, in the meantime, welcome everyone who has joined so far. We'll be starting to give a few minutes to everyone to start logging in. I'm just going to handle the people who still have problems getting in. All right, we'll see you in a few minutes.
Let's welcome everybody. We'll probably start at 5 past. Would that be good enough?
I think that's good. Okay,
so just give another 2 minutes if you need a cup of coffee, anything to get ready. Hot chocolate or hot soup, or I don't know. But anyway, get yourselves ready. We'll start in a few minutes' time.
Right. I think we can get
Okay,
going.
so yeah, so I think we should start. It's 5 past. Welcome everyone to this very interesting session. Welcome Hugo for joining us, and he's going to talk about cross borders activities. But I suppose today, with taking Poland as an example, there's some very cross borders. But anyway, it's going to be an interesting afternoon. Today, I'm sure most of you are aware, is the shortest day, longest night, and the summer starts tomorrow officially. So welcome, and Hugo, it's all yours. We're going to break after about an hour. There'll be questions. If you at that point want to go and get a cup of coffee or whatever it is you want to do, body break, then it'll be in about an hour's time. So Hugo, thank you for this, and the floor is yours.
Good morning, Stan, and then everybody else. I hope you can see my screen. So up front, apologies for using the speaker so close to my mouth. It is because I'm sitting in a public space. Some of you may know that I'm actually visiting my clients in Germany, Switzerland, Spain, and I've been to Netherlands and Belgium last week. So we're having sweltering heat, and then last night in the southern part of Germany, we had a hailstorm. My first one ever, but anyway. So yes, the break is going to be in an hour's time. The information and the updates this year is not that much, so probably the presentation part is only 2 hours. I will ever so often stop and then try and address the questions and answers that's in the question and answer box to make sure that we don't leave them all till last. In that question and answer break or period, if you quickly want to go and have a cup of coffee or smoke break, I won't know and I won't be offended. But anyway, so a little bit, if I can just do some marketing. I'm a chartered accountant. For those of you who noticed something big difference there, I have removed myself as a certified tax advisor. I'm totally objecting to the fact that certain professional bodies, RCBs, are not allowing all the CPD points that I'm creating for my colleagues. My passion is training my colleagues, and I think it's very unfair that certain CPD groups or RCB groups exclude private CPD players. Mr. SARS tax practitioner, our tax forum group, the one that you know, and the Wegkaner still exists, but we have merged into a group called 22 Services. So I am still the controlling shareholder. I'm still the chairman, but I have now 2 new directors. One is Matthijs, he's a lawyer in Cape Town, and you all know it's part of that UBO declarations for trusts and also for companies. And then in my Dubai office, we have appointed Bronwyn Victorious, she's a CMA and an honors graduate from UPE, from Potch, I think, and she now lives in Dubai Marina. So although I only live there 6 months of the year, she lives there full year. So there's all the contact details that you may need, okay? Now I must just find out how I operate this. Oh, and then in the meantime, I have a new computer. 2 days before I left South Africa in February, my Mac was stolen. But anyway, so that be it. The topic today in blue is going to be mainly income tax focused. I'm also going to touch on some proposals. And as you know, we have not seen the draft law about that. So that part of the discussions we all have to accept. It's purely discussions. My personal opinion is the one on trusts, which we'll deal with later, on foreign resident beneficiaries, will probably not be done this year, probably next year only. So let's get that straight. We have a situation where the Reserve Bank said we have relaxed exchange control. A South African trust can beneficiary anywhere in the world, and we do not mind if the beneficiary is a trust or a company. And SARS is clearly not happy with this. And Treasury is playing yo-yo between the two because they're the policy makers. And I'll show you how the policy flicked back in the last 18 months. The green control. So I'm doing a recap our last CD feed for Dan and Stan, but it was so that you can just understand the differences. But the 23 changes actually reverse some of the changes in 2022. First time ever since we have the current government that tax or financial laws were backdated. It happened on the 23rd of May, and I'll show that to you later. But anyway, if we look at 23's budget and other changes outside the budget, I think the most important one is Interpretation Note 127 or IN 127 that was published in January before the budget, and that deals with the determination of the taxable income of certain persons from international transactions. That's intra-group loans, and it's an official guidance on how SARS will apply the provisions of Section 31 regarding transfer pricing. Now, they focus on intra-group, which means it must be a group of companies. I do feel that we are looking after individuals and offshore trusts or individuals having invested in offshore trusts. We need to take into account the provisions and the comments made in that interpretation note. So that's the first one since we had many years ago, the guidance notes 2 and 7. Okay, so they have been withdrawn, and this is now the official statement. Keep in mind that they've also indicated that 31, the dealing with, or the one allowing us to deduct interest against interest income, so a little bit of an override over Section 11A, the purpose test, that will soon be abolished. They've extended the date, but I do think this will be abolished. We do hope that there will be alternative rules brought into place, or we hope in October to see some draft bills or tax laws being implemented to bring back a certain part of Section 31. Sorry, not Section 31. The reason for that, let me put a practical example. A South African trust cannot advance money as a loan to an offshore trust. So what we typically did is the South African trust advanced a loan to the beneficiary, or a South African company advanced a loan to a director or an employee. That individual then took that 10 million and took it out of the country using the old FIA allowance. Now we have a loan from a South African tax resident individual, because that's what the Reserve Bank wants, to a trust living abroad, being a tax non-resident trust. In terms of Section 7.8, Red 31, and also later 7 Cap C, because just to interrupt myself, remember, if Section 31 does not apply to an offshore loan account, then Section 7C, Cap C can still apply. So in all practical terms, we normally had a South African advancing money to an offshore trust. To overcome the anti-avoidance rules, the South African individual will then charge interest at arm's length rate to the offshore trust. Just an example, we'll receive 10,000. Let's assume the 10,000 pounds then becomes multiplied by 10, it's 100,000 rands. I know that's not the rate, but I just want to keep it simple for my simple mind. Now I have 100,000 rand of interest coming into South Africa, either as a deemed income or an attribution, but not always as a physical inflow. So the loan account could be increased. This very same individual, to ensure that there was no deemed dividend within the company, would then, at the prescribed rate, it's a repo to the company. Otherwise, it would have been a fringe benefit loan. So now the employee
Hugo, can I pause you for a second and ask you
Yes.
just to turn your video off? Because I think you're getting a bit of bandwidth issues that it's your sound keeps breaking up every now and then.
Okay, let
Wanna
me
ask?
do.
It's just yeah, and then just keep your screen on, but we'll just turn your video off.
Better.
So let's hope. Let's see.
Let's hope that's better. My sincere apologies. I don't know why it's happening because on my I have a little screen thing here that says I'm on full 5G. But anyway, so just to recap, so we now have 100,000 rand of interest, either actual or deemed, but we only interest to the company in South Africa. Now that 10,000 rand, the delta, was taxed as the net taxable income. In practice note 31's allowed for this. Now they want to abolish that. So those existing loans. Furthermore, in that determining of the arm's length loan, arm's length interest from the foreign trust or the offshore trust, a lot of, and everybody accepted LIBOR. First of all, LIBOR no longer in its traditional sense no longer exists. And now suddenly in this interpretation note, and I'm now back at the slide, there's no safe harbors. Okay, so those people who had rulings from SARS to say that LIBOR was a safe harbor, it is no longer a safe harbor. Okay, they now include indirect financial assistance, guarantees, and things like that. And those guarantees are now allowed in terms of the circulars issued by the Reserve Bank in 2023. So South African parent company can now give a local or foreign guarantee to its subsidiary in London or USA. Then in determining the commercial and financial relationship is very important. Let's consider both sides of the transaction. So it could be that this individual could argue, I'm only going to charge 4 or 4.5% in dollars because I cannot invest in America for much more than 3.5%. But now they say you must look at the other side of it. That trust with no history would not be able to borrow in the US for anything below federal interest rate, which at the moment hovers at about 5. And then very important is that they now want an annual review of that interest rate. So you can't now say, when I made that loan in dollars, the Fed rate was only 1.5%, therefore 2.5% is a good arm's length. You have to review it on a regular basis. They also agree that advanced pricing agreements will be accepted in future, but there's no final rules on that. There's a separate process to have that put in place. Okay. All right. The other one, and this is the one where we now can have an interesting debate about. The taxation of income distributions by a South African trust must be aligned, or they suggest, aligned with the taxation of capital gains vested in a beneficiary. So let's recap the law. In terms of current South African income tax law, 8th schedule, if a South African trust vests capital or the gains on a capital asset to a non-resident, then the trust must pay the capital gains tax, which means 36%. You cannot apply the conduit principle. Okay. So even if you follow trust law and you distribute an asset, if it was a South African beneficiary, the South African beneficiary must pay the capital gains tax, no option. But when it comes to a distribution of a foreign asset to a non-resident beneficiary, that non-resident beneficiary will now not be taxed, or for a while already, and only the trust will pay tax at 36%. Okay. Now, SARS is saying they want to do a total switch off of the conduit principle on beneficiaries not resident in South Africa receiving any trust vesting or distribution. Any trust vesting or distribution. Now, we have not seen draft law, but in the explanatory note, which I think was annexure F and C of the budget speech, they actually overlooked so many critical points. So whether this was a new minister trying to put in something that would make him unique and stand out for the new changes he made, I don't know. But it's actually shocking that that document was published, because they totally ignore the fact that at the moment, if I distribute interest to a non-resident beneficiary, there's actually interest withholding tax. So if they are now going to tax that interest in the name of the trust at 45%, how can they then, in addition, charge 15% withholding tax against the beneficiary? Because it's the same amount being taxed twice. And as we all know, that's a principle of law. You can't tax the same amount twice. It's an interesting little further debate. Can the same amount be taxed twice, but in two different names? So remember, the 45% tax on the interest distributed is in the name of the trust, but the 15% withholding tax is withheld, although it's withheld by the trust, it's for the credit of the beneficiary. Now, current law, if the beneficiary then files a tax return and then claims that 15%, he should be able to get a tax refund. But again, will e-file systems be aligned to that? And the cash flow consequence was clearly not considered. So these type of things were immediately brought to the attention of Treasury, and we have therefore seen that this year, normally around about mid-June, we should have had the first drafts coming out. Remember the year of 7C, it was actually, I think, on the 23rd of July only we saw that, because there was so much debate about 7C. So the fact that it's not been published does not say they're not going to try for this year. They can publish probably up till about, I think it's end of July, because there's by parliamentary law a minimum time lapse between the date they publish it or table it in law in Parliament until the mini budget. The reason for that is, remember, any tax is what they call a money bill. It must go into public debate. Treasury must do roadshows for everybody to comment on. So their time is running out. And the second bullet point then, income which is vested in the South African resident beneficiary in the same year of assessment will continue to be taxable in the beneficiary's hands on the current flow-through basis. Okay, that's current rule. Okay, and now the next rule is any investment which is vested in a non-resident to be taxed in the trust at 45%. Now, quite interesting, link that to the new proposals that SARS wants an IT3T, the new up-to-date reporting by trustees. Here comes the next problem. That IT3 may still treat that beneficiary as resident because he's in the process of updating his RAV01. So there's going to be a lot of practical issues. And then the last one, I'm not an advocate or a tax lawyer. I'm a tax accountant and I'm a chartered accountant. Some of my colleagues in the legal industry says they do believe SARS has no right to override normal commercial and English common law, that the conduit principle is something that is a principle or tax principle outside the Tax Act. So they seem to now want to override the principle of conduiting and sending it through to the beneficiaries. I personally, my interpretation is they're saying you can put it through, you can vest it, you can distribute it, but we don't tax the cash flow. We are going to create a different tax trigger. And that we must remember, and I've been criticized for that many times. My principle is tax is not logic. Tax is a figment of Treasury's mind. If you, for example, think about Section 7C, there's no logic in it because no interest was paid. But there's donations tax on the interest you did not receive But in that interest not received, they then first do an income tax calculation using bank repo rate +1. So can you see that cash flow and tax are not linked? The other one we see that is where tax is in figment. If you look at section 31, the difference between section 31 and 7C is that in 7C, they only raise the donations tax. The interest that's deemed to be waived is not attributed to your name. But the minute when it's an offshore loan, so you've advanced money to an offshore trust, now suddenly in the primary adjustment, you taxed on that interest. The interest is attributed as a deemed income. And then again, that deemed income is subject to donations tax. So it's a figment. It's not a real donation. And then for those of us who are very purist in tax law, when you look at 7C, you must pay the donations tax by end of March. When it comes to section 31, the secondary adjustment, that donations tax only needs to be paid. So not only is it a figment, it's manipulated by Treasury decisions. Okay, Treasury decided one is March, Treasury decided one is September. When we challenged them at the time, no answer was given. And the only answer I can think, and I don't want to answer for them, is that remember when we use the average exchange rate to determine the interest calculation, the February 2023 average exchange rate will probably only be published in May, June. Therefore, they give us that extra extension. Who knows? But anyway, back to this topic. The assumption there is that where income or capital is vested in a non-resident beneficiary and taxed in the trust, the non-resident beneficiary should have no tax implications. I'm going to say that again. Should have no South African tax implications. My question is then, on the current tax return for trusts, you cannot distribute to anyone who has got no tax number. So now the tax return is going to ask the tax number of the non-resident. I now have to register someone who is not liable for tax in his personal name for a distribution made to him that is taxed in terms of a figment policy in the name of the trust. So can you guys see why I believe that even if they make the change, let's start. Even if they publish the draft bill, they need to go back to the back engines of their own e-file system and tell us how they are going to change that. Because when we get to the exchange control side, the Reserve Bank already says a South African trust, Interviews and Mortis Causa, can distribute the interest to the non-resident without the non-resident beneficiary obtaining the old FIA or the new AIT TCS PIN letters. So the Reserve Bank is on a very purist legal mindset saying a distribution from a trust to a beneficiary can go to the beneficiary wherever he is situated. If SARS then now wants to align their tax policy with the Reserve Bank and say, okay, but then we tax in the trust because they're the ones that must get the tax good standing certificate, then surely SARS must change their policy and not all trust beneficiaries need to have a South African tax number. So we already have that, I'll get to that later. Since August 2022, we can distribute from a South African trust to a foreign trust. Now that foreign trust has no tax number in South Africa, and we do not know how SARS are going to deal with it. I tried to open the tax returns 2023, and remember tax filing season starts 7th of July only. So I think the IT12s and IT12, what's the trust one? IRT 12 is already final. but it doesn't they allow me to have a distribution to someone who has no South African tax number. I'm told, and I'm really saying I'm told, it did not come from inside SARS, it came from one of the RCBs, that for the distributions to these foreign entities, there is a manual letter that SARS must issue, and on that manual letter, they will use a reference number, and we'll have to then capture that reference number as a tax number. And before I go to the next slide, that's a why is our tax numbers different to our ID numbers, or continue to be? For history, for those who don't know, it was at the time when Black people were not allowed to have a South African ID, but they were paying tax. How fair it was or unfair it was, I'm not going to comment on, but now everybody has the same ID number. Therefore, it is only absolute non-residents, okay, that owns property in South Africa that needs a unique tax number, or TIN as the Americans call it, and then in this case, foreign trusts who has no presence in South Africa. But anyway, before I go to the next slide, in summary, an interesting proposal, I think will bring in a lot of tax to SARS. I can see why they're doing it, but unfortunately, the proposal as it stands, as a policy, before we have seen the legal draft bill or the tax bill, is totally inadequate. I just want to see if there's a question on the question and answer that I need to answer. Okay, not at the moment. Okay. Okay, sorry about that. I've done the wrong thing. Okay, right. Sorry, Dan, just a minute. Can you guys see the white overlay there? I don't know why that is there. So I'm going to dismiss it. Okay,
is that better?
Yep, now it's gone. Okay. So if I may ask, if there's any things coming up, just read them to me and say to me, stop, quickly answer those questions, okay?
Will do.
Thanks a million. The other, and now we've done with trust, now we're getting to just general cross-border proposals. So first of all, we know the fact that the OECD has this introduction of a two-pillar system, and the other big one is the minimum tax rate of 15% for corporates, okay? So South Africa is not really impacted by that because our 15%, or we're above the 15%. What is quite interesting is that for larger groups, $750 million and more, the effective tax rate must be 15%, which means that even if they then have special deductions or allowances, technically SARS will have to cap that and say, as long as your actual tax rate that you pay for the current year does not go below 15% of profit. So SARS is not too up to date with that and making not too many comments about that. Just for those of not aware of it, I spent 6 months a year in the UAE, and as of 1 June 2023, very fresh, we now have 9% what they call corporate income tax rate. But it's interesting, it's a tax on corporates, trusts, foundations, in any individual trading in his own name. So for example, I trade in Dubai in my own name. I have to pay 9% tax. There's a very high threshold though, so only on the amounts above that. But they have at this stage excluded residents of the UAE. And remember, there's a difference between a resident and a Emirati. An Emirati is someone with a passport, and they do not grant passports to foreigners like any other country. So we as residents, with our residency permits, we do not pay 9% tax on commercial or residential rental income, but a company or a trust will pay 9% on both residential and commercial rental income. But on average, it's for companies, okay? SARS follows and is accepted, Treasury has accepted the OECD model, back onto the screen now, and the two-pillar approach has been formally accepted by Treasury. On the first pillar one, they just reported back that there's still no finalization on this part, okay? And Treasury will follow OEC, and they say, spelling it apologies, OECD process once it is known, and that deals with the digital economy. For those interested, what the difference in delay is, it started with President Trump, the previous president of America, and the French. They are totally at loggerhead as to how digital economy must be taxed. Remember, in South Africa, we're one of the front runners. We do tax on value-added tax purposes. We do tax certain digital or e-services for value-added tax purposes. But to bring it a little bit more practical, I work in 7-8 countries a year, so I could be called a digital nomad because SARS e-file allows me to be that. In countries where I spend less than their qualifying term to be a tax resident, I do not have any tax liability at the moment. And obviously this digital economy now needs to address where a digital nomad is sitting. The other big part, which most of you deal with on a daily basis, is you have companies in South Africa who no longer operate such big offices. So they now allow their staff to sit in any country of the world, okay? So those people are working remotely. And now the question is, double tax treaties were written in the way to say that once there's an office in a foreign country for more than 6 months, then you actually have to register as a tax country. We look at our own situation. If you go to Sub C says a foreign company, external company, if they only operate the bank account in South Africa, they do not need a Sub C registration number. SARS says these e-service providers, and they're not my client, I'm just using this as an example, the antivirus group, they don't have, you're going to go and look, there's no Penske LLC, the one selling you the license in South Africa. There's other Kapenskis, probably R&D companies, I don't know what they do, but the company to whom you are paying VAT has no subsidiary registration in South Africa because it has no employees in South Africa. The employee is sitting in another country in a call center. We now suddenly in South Africa have a situation that foreign companies allow their staff to come and sit in South Africa, and they now work remotely in South Africa. And remember, we had a source-based tax for those non-residents. They immediately have to start, unless the tax treaty allows them to claim an exemption. But you must now look at the employer. Our double tax treaty says, when that employee sits here and has effective management rights, or has any managerial decision-making rights in terms of the treaty, because treaty overrides effective management, and that office is here for more than 6 months a year, then it's a deemed branch in South Africa, and South Africa can raise tax. And why are we as tax? Those digital nomads, we have been helped tax returns on source base. So they pay tax here. Wonderful. What have we helped them to claim a home office? And in some of the cases, we've even submitted to SARS a letter saying that they are obliged to maintain their own offices at home to justify the expenses. That letter and your claim may have just caused a tax problem for the employer sitting in America, but that's a debate for later. But what I'm trying to do, and it's going to come through quite a bit in today's presentation, is that cross-border is no longer one flat single transaction. There's just so many transactions around it that we need to consider. If we now go back to the screen at pillar 2, that focuses on the remaining base erosion and profit shifting matters. And the big one of that is the transfer pricing. So remember I said earlier on the slide, there is still no system to get a pre-approved transfer pricing policy and SARS with SARS, and they have now indicated that will be in the 2024 taxation law amendment bills. So we are not going to see them in this year. So although it's in the budget, everybody got all excited that we're now getting into transfer pricing and more certainty. We only have interpretation note 127 to look at. We do not really have a full interpretation note as we had with the old practice note 7 that said you could, for services, charge 15% above cost price or 15% below selling price. Remember, there were, I think, 4 different methods that we could determine transfer pricing. That is still a gap in our tax law or guidance from SARS, and we're not going to see any answer before next year. In 2022 drafts, okay, advanced transfer pricing policies were made public, and there's been some comment by Treasury on the answers that came in, but the only thing we have seen to date is then interpretation note 127. Okay. So now, before I go to the e-files, Dan or Stan, is there the questions? I see there's 2 questions. Is there anything I need to answer right now?
It's just someone who keeps going on about the sound. It seems to every now and then I think you break up. But
my sincere apologies. What I'll offer is that we'll re-record it and then send it out once I'm back in South Africa. But my sincere apologies for that. Yeah. All I can think is the bad weather, because at my side it's in total green. The little Wi-Fi signs is full, yeah. So I have no indication.
I thought it has. For me, it improved since we stopped the video. But
okay, maybe they must also then switch off their video to improve their own bandwidth.
No, it's yeah. We'll okay. Just keep it on as see how it goes.
Okay, all right. Okay. So now comes the 2023 e-file changes, and when I prepared these slides, I was not aware of that nasty threatening letters that SARS are now sending out to anyone, where SARS did an override tax return. Now, one I had this morning, which irked me endlessly, is a case where it was a auto assessment, and we then objected within luckily the 40 days and showed to them that they did not allow the medical deductions correctly. Then we asked that we did a request for reasons. Then they, out of their own, changed it, and they then allowed the deduction, what they thought was correct, but they excluded the expenses privately from the medical aid. It lists the amounts that you paid for yourself. Then we asked for a request for reasons, and because it was a SARS adjustment, they wouldn't allow that, so we had to do a full objection, and we did the full objection, and we had to prove that that expenses was actually paid by the taxpayer and not by his spouse. And then again, and now being an objection, they then issued a letter saying the objection was allowed. So in my mind, this is a tax system. He got a letter and me then warning me that they're going to raise penalties in 2023 tax year or the 2024 filing seasons if there's repeat offenses where SARS has to intervene and issue and amend assessments. Very, very unfair, because it's not in the taxpayer error, it was an auto assessment error. But anyway, so first of all, we now sit with a tax law that says we have to change our particulars and register details within 21 business days of such change. That's the local law. But I cannot update your RAV to the new address, okay? Often not even in 30 days, because in the first month, your company provides you with hotel accommodation in the new country. Or, for example, I'm going to again use UAE where I work. You must be resident in the country 183 days before you can get a tax certificate. So I can't do the RAV 001 update before, say, 184 days. And to be honest, it's probably at 200 days, because after 183 days, I still need to go to their tax authority and get a tax residency certificate, which means I then have I need another 2-3 weeks before I can file. I can change the address, but that's going to, in most cases, trigger a query. And if I just change the address and nothing else, we still see that SARS are then sending out letters of verification asking you to verify the change of address. And now we've seen with the new AIT process, that's the one that replaced foreign investment allowance, the TCS one for AIT. If I have a foreign address on the RAV, and I then file an AIT asking to take 10 million out, I get an immediate decline saying it's declined because they've noticed the foreign address and I haven't completed the tax immigration process. And what a mission to explain to them that I may have a foreign address, but I'm not able to tax immigrate. Practical example, South Africans who do investor visa to Australia can never get a permanent residency permit. Okay, the minute your investment falls below certain values, you lose your visa. The double tax treaty between South Africa and Australia says you'll only be deemed solely tax resident in Australia once you pay tax in Australia on worldwide income. In their tax law, anyone on a 457, the work visas, and the investor visas, and certain of the parental visas, do not basis. So that client has a foreign address. He has sold his South African home. And he cannot tax immigrate, not in terms of the treaty, and also not in terms of the ordinarily no longer resident. So this one is really a problem, but just take into consideration when your client spoke to you, ask him to help him with pre-immigration planning, you have 21 days once he has left the country to update. Okay. So tax filing season starts 7th of July. So what I've done in preparation for today's meeting, I then went to one or two of my clients where we did the RAV update and we got the letter of immigration. So I sit with a letter of immigration confirming my client tax immigrated on the 25th of April, 2021. And when I opened his e-file, unlike 2022, it has pre-populated. Now, this test I did was 1 or 2 clients, and I do very little tax returns. I'm more a tax advisor than a tax compliance officer. But on both of those clients where I opened up the IT-12s a little bit early, before 7th of July, the letters that was issued during late 2022 and early 2023 already shows on their files. Now, this client, for example, has a foreign passport. He was indeed someone who immigrated into South Africa with an I. So what did not pull through is the one above, marked with an X. If you are both a non-resident, okay, and you have a foreign passport. So it's a foreign national and a tax non-resident, which he then is. And I see we can click that block is open for us to tick. So the good news this year is that the 2022 pre-populated information on people having immigrated has now been fixed, provided your client sits with a issued in the new system. Anyone who had an immigration letter on the
Sorry,
formal...
just repeat that. We broke up for a second.
Yeah. It only pulls through in respect of people that has a letter of immigration in the new era. So somewhere from February 2022 to date. If issued by a bank or by SARS in the formal immigration era. So that was before 1 March 2021. 1 March 2021. Then you have to reapply and redo part of the system. Not everything, because you've already paid the exit tax. You just have to go through the processes and prove the person remains to be tax non-resident. Because those people who financially immigrated or formally immigrated, as I prefer calling it, or the people who did the tax immigration ticking the ITR 12 question up to 2021 tax year, those are not pulling through and you have to redo it yourself. If you, for example, go into the RAV form, you'll see that when you open up the RAV 01, it at the top says foreign individual. Now remember, there it reads foreign individual, and the question on the screen is foreign national. So although undefined, there seems to be a difference. But now you have to go, when you're on your e-file screen, there's a little agenda or index in the middle. You have to go down in the middle to what they call tax types. Then you click on income tax, and you click on the income tax number, and then you scroll right down to the blue bar that reads liabilities. And there you will see it now shows resident. If your client has done a formal immigration or the old IT-12 immigration, and you click the word resident and change it to non-resident, it should, in most cases, pre-populate the date that SARS has in the background as your immigration date. You then click the button done and you resubmit, and you unfortunately get an entire inquiry asking all the documents that a new immigrant needs to supply. We have had great success to say, here is the detail of when we did it in the past. Here is a current TRC, tax residency certificate. And secondly, and that's the big new one, or the two ones that you have to now put in. First of all, herewith is a travel diary, and I highlight the travel entry into South Africa, the visits into South Africa. And then you have to explain that they were all incidental and not doing business, it's family or whatever reason. And the most important one is there's a new document called Immigration Declaration. You have to sign a document to say, I now declare I'm tax non-resident. So the ITR 12 declaration of 21 or earlier is no longer adequate. On that, you then have to select either you did it on the 330 days or on the double tax treaty or no longer ordinarily resident. And then you have to capture a date there. That date that you capture on that document must agree with the RAV one that I earlier explained. If they do not agree, SARS is going to decline your new letter application. And then one that I insist my clients submit, but I see some of my competitors say it's not required. I still believe it's important. SARS are asking on that standard inquiry for a letter of motivation why you consider yourself tax non-resident. If it's a very easy case and he lives in another country and it's a double tax treaty immigration, then I would suggest the client do that letter, and it's a what we call motivation letter. When it's someone who has gone out as treaty resident and is now no longer ordinarily resident, okay, and I'll discuss when it can happen, then I suggest two important things. The declaration letter must have the date of DTA, the first date you became non-resident, because that's the date SARS are going to use for exit tax. But in your motivation letter, you must then say, I went out in 2012 on my double tax treaty claim or benefit with England, but now in 2021, I was granted a UK passport and I no longer wish to return to South Africa. And therefore, I am now no longer ordinarily resident. So effectively, that form that you, or the declaration you do, is in a way conflicting facts, because you have to say the reason why I'm non-tax resident is the current reason, being ordinarily not resident. But the date you give must still be the date that you left initially, or the date in terms of the double tax treaty applicable at that time. So that's a bit complex. And in that motivation letter, one has to then explain it. So when a client has gone out and changed from DTA non-resident to ordinarily no longer resident, I do suggest that you write a bit of an opinion letter. Look at Tax Administration Act, Section 223, and you do an opinion letter as a motivation letter. Your client can still do it, but your opinion letter will help. I know there's tax practitioners who feels that a Section 223 opinion should only be submitted to SARS at court case date. If you don't want to do it as a formal Section 223 opinion, just do a normal covering letter. Say you have read your client's motivation letter and you agree with them, and you just explain that if you look at Annexure A, it's the visa of 2012, which was a 2-year work visa to the UK. Look at Annexure B, which was the indefinite leave to remain granted to him in 2018. And look at Annexure C, which is his grant letter stating that he is now granted UK nationality. Because you sometimes have people that have been granted UK nationality, but they have not applied for the UK passport as yet, okay? And that could be for various reasons. So the supporting document need not be a second passport. It could be a letter of grant. Furthermore, for other countries that have golden visas, it may be the investor visa that you attach to show that he's a permanent resident of another country. Okay, so most important is that your e-filing this year should, I suggest, not start before you have commenced the RAV01 update. So the two can run parallel, okay, but do not file your 2023 until you have filed the application for the letter stating that you're non-resident. The reason for that is very simple. If you start on your tax return for 2023 and you start claiming interest exemptions based on the treaty, you're opening the client up for understatement penalties. Okay, so please be mindful, the one must follow the other. Okay.
Can I just pause in for a second?
Yeah.
There's a question saying, can we backdate the non-resident status prior to Feb 2021?
Absolutely. It's totally legal to backdate it. And the reason I put it in my motivation letter, I stated the SARS e-file system did not allow for us to do it earlier. Therefore, although we tax immigrated on this day, we now place it on record, and we specifically ask SARS to backdate the effective date of tax immigration to 2012. And I have a client that technically it was not possible in the law, but the letter says he tax immigrated on the 31st of December 1998. Now, everybody will know that we didn't have the residency test then, and we were not on the worldwide basis. But I think their template doesn't allow for that in any other case. So yes, do indeed. And secondly, going with that, if you—
and then it's the follow-up is that it does not need to disclose any foreign income after that date.
Correct. No foreign income unless there's an attribution rule to South Africa. But it's a very, very few cases that will happen. Just want to also add, if your client has done a formal immigration and the letter stating that he's now non-resident issued by the Reserve Bank says effective 1 March of 2018, but the treaty allowed him to be outside 2012, you can now override that and use the tax treaty date of 2012. The reason why the Reserve Bank did not allow people to backdate their financial or formal immigration at the time is that if you use your credit card between departure date and the date you filed your MP336, they were reluctant to move your immigration date earlier because, strictly speaking, as a South African, you were not allowed to use the credit card outside. Also, on that topic, I think I'll cover it later, I do think, but let me just, because that's a very, very good question about the backdating. If you are now facing and you're sitting with your client and it's 7th of July, you're heading up for 23 tax filing, and you agree with the client or the client asks you, please backdate my tax immigration to, say, 2017. If you then pick up that there is additional tax payable being exit tax, then you are best advised to do a VDP. And the minute you have the VDP number, you can commence the immigration process, because once the VDP number is in place, SARS can't charge the penalty. But remember, if SARS had any information at hand, or they can argue they knew about this transgression, then you're in for a little bit of a challenge. Now, I have had 1 or 2 cases where SARS said, I'm going to raise a penalty of between 25 and 50% in the VDP process. And the reason was they have record that you filed for financial or formal immigration in 2018. And at that stage, you filed the balance sheet saying no South African assets. Okay, because remember, MP336 was all about South African assets. And we knew that you had foreign assets because of CRS, Common Reporting Standards. So please be mindful that, you know, the VDP is not always without penalty, but just to make sure that your client is protected, I do suggest that the VDP be done first, then the RAV01 update be commenced, and then only you file 2023 tax return. Unfortunately, there's at the moment no process in South Africa how to deal with the 2013 to 2018 tax returns where technically you've overpaid tax. Because remember, the minute there is a refund, you are disqualified for VDP. Even our new dispute rule says you have a maximum of 3 years. And in very, very unique circumstances, can you go for a longer than 3-year reduced assessment for more than 3 years back. But the Tax Administration Act at this stage does not allow for a technical correction where you've later discovered that you are tax non-resident. This is very, very important for our American clients because many of them have only recently discovered that they should have tax filed in America as tax resident from the day they had their green cards, even if they were living in South Africa for substantial time. But that's a topic for another day. Okay, so in summary, please feel free to backdate. Just consider the VDP. Don't worry about it if there is no additional tax, because there's in the Tax Administration Act no way to technically correct a 2012 or old a tax return more than 3 years old. AIT, some of you who know me well, follow me on LinkedIn, will know that I had this huge debate with a very certain specific investment advisor and quasi-economist, saying the AIT process was a clamp down from an exchange control position. It absolutely was not. It was a change that followed the tax law, exchange control law amendments announced on the 20th of February 2020. 20th of February 2020 should have been the implementation date of the AIT. Secondly, now on the AIT process, there are certain information that we feel is an addition to the previous application. Not so. It is in addition on the first step. So when you fill in the form, you now have to enter the bank account number and which bank it's held and the amount per bank account before you can submit. And you must submit your foreign or offshore balance sheet. In the past, SARS came back with a tax query, normally asking you for transactions in the last 3 years, and they asked you for a balance sheet if you did not fill in a balance sheet on your tax return. So now SARS has removed that double review process where they receive a half-baked FIA application because we were too lazy to capture everything. And they now say, these are the standard things we're going to look at. We want to know exactly your bank account number, and then the bank account number is listed, and you can only apply once you have captured quite a bit of detail. So my advice to my colleagues is, before you do an AIT, look at the PDF manual they issued at the time. They clearly list everything that is required. So now clients need to maintain 3-year balance sheets, okay? And of each category, you must keep a history of that assets, the buying and selling. You anyway need it for capital gains tax. So start doing a cumulative balance sheet for your clients. Because remember, we've all forgotten that in 2022's budget proposal, there was a proposal that SARS now wants balance sheets for people above a certain net asset value, and they want that balance sheets at market value. Now, that was for a different reason. I think, my personal opinion, that was aimed at wealth tax coming in. But the point is, SARS is going for balance sheet reviews and lifestyle reviews. If you're against fraud and all these tenderpreneurs and the way people are stealing money, working for government, then you must support the fact that SARS wants a balance sheet from everybody. They cannot check your lifestyle if they don't know your balance sheet. But remember, they now have so much third-party information on you that in a certain way, part of the tax return is just an honesty check because they already know the information. So suddenly on the evening of 23, Sunday, 23 of April, Monday morning, 24th of April, there was a new system in place and they said no more good standing for tenders, okay? Only a general good standing, and that is good enough for government tenders. And then they've combined the foreign investment allowance and the tax immigration clearance for immigration, TCS tax immigration clearance. They've combined that both into an approval for international transfers, AIT. Furthermore, when you start with the AIT, you have to now indicate, are you a resident or are you non-resident? And they actually do check that choice. As I mentioned, we've now had cases where we had declines because of the fact that the address was Australia, but the client has not indicated that he has he indicated tax immigration, but he has not completed the process. At the moment, there's no automatic upload on day of application, but I have spoken to some of the very senior guys in the spec writing side, and we've asked them that we need to upload some covering letter because there are questions in there that they need to know or information they need to know. The other argument that this certain Mr. Magnus had was, now, why are they asking for a foreign balance sheet if I've tax immigrated? Now, we just had the question, SARS can't tax foreign income after tax immigration, 100% correct. But do not forget that when it comes to estate duty, we only have about 2 or 3 effective tax treaties, okay? The one is with America, the one is with the UK, and the other one is, I abbreviated as BLS countries, the Botswana, Lesotho countries, okay? So for now, we're going to ignore the African countries because South Africans, some have some assets on both sides, but it's not too much of a concern. But I'm going to use a very practical example. If you have moved to Australia and you now have an Australian permanent residency permit, you're an Australian tax resident and you can tax immigrate. They have no estate duty. Until the day that you are ordinarily no longer South African resident, South Africa has the right and will indeed collect estate duty. So there's an obligation on you, or you, not on you, you did, on your executor to register your death in South Africa. And at the moment, sometimes it was quite a challenge because some masters, and it's not a joke, I've seen one 2 weeks ago, where the master insisted on a death certificate issued in South Africa. Now, this death certificate was issued in French. I've seen requests to say, give me a death certificate translated or a formal translation through the embassy. But then this client is now forced, the client is the executor. He now has to register the death that took place in France at South African Home Affairs. And he's been at this for 9 months, okay? Because the French death certificate says natural causes. Gentleman was 89 years. Sounds good to me.
our Home Affairs insists that although it was natural causes or age, was it lungs, was it heart, was it an aneurysm, or was it a stroke? And now we must go back 14 months to a French doctor who doesn't understand English and ask him, can you remember when you issued that certificate, did it look like he had a heart attack or a stroke? And I expect that doctor to reply, he was blue in the face, you decide. But anyway, sorry, that's not the nice joke, but it's really, our Home Affairs are really silly at this stage. But anyway, back to the duties. You have an estate duty obligation on your worldwide assets if you have declared that you tax immigrated on a double tax treaty. Can you see now, going back to my letter, why I say when your client has gone out on a treaty and then changed to ordinarily no longer resident, why you should add a covering letter, why you consider him to be no longer ordinarily resident. And then you have to start practice what you preach and then have a will dealing with South African assets only, making sure that that will does not withdraw or override any will elsewhere in the country. And you administer, or the executor administers South African assets completely separate from the foreign assets. Also remember, Estate Duty Administration Act, Section 25 says, if the deceased was no longer ordinarily resident, and he had no title deeds, properties in South Africa, then the foreign executor can be registered in South Africa, provided he appoints a local agent. He does not need to file a South African liquidation and distribution account, but he must give evidence of the REV 267, the estate duty form that was filed in South Africa. My experience is in most cases, we do an liquidation and distribution account. The reason for that is many of the banks are reluctant to release the cash if there is no evidence that the deceased's estate is technically solvent. Okay, so just take that into account. And why I'm so aware of it, just as an interesting story, remember in 2003, we could all do amnesty, and I had a client who then did the amnesty, paid 2% because he donated his loan to the foreign trust and then paid 2% levy. So now he has got no foreign assets, okay? But in South Africa, he still owed money to his South African company. And guess what? He died technically insolvent in South Africa. And the bank, knowing that he signed guarantee for the overdraft in his company, was very reluctant to allow that cash to be distributed, because they said, first of all, a big portion of that cash comes to us because in that case, he had a limited guarantee of 12 million. But the shortfall, because of the loan, the additional amounts advanced to him subsequent to the bank guarantee was another 20 million. He was 32 million rand in the red. So be mindful with these clever tricks we do that we don't cause technical insolvency in South Africa. But anyway, back to the screen. As you can see, this client I chose is one of my active clients. We first started with a good standings certificate. Then last year I had a foreign investment allowance. And as you can see there, he had an immigration clearance as well. This client, unfortunately, on his IT12 for 2022 and for 2023, his tax immigration did not pull through. So although he is formally immigrated, we did an immigration tax clearance or TCS PIN at the time, the system did not pull through. We then escalated this through to SARS, and we just had a reply about 3 weeks back. Unfortunately, we have to now follow the new process, because at the time that this tax immigration was done, there was no letter issued to confirm that he was no longer tax resident. So that's why I'm sadly saying to many, many South Africans, when you paid for formal immigration, you may have paid for something that has no value of today. Now, I couldn't open, well, I could open the foreign investment allowance for you to show what happened. We applied for this client for a foreign investment allowance on the 7th of March. Remember, the AIT process came in on the 23rd or 24th of April. So on the 7th of March, we filed. Then roughly somewhere around Easter, 9, 10 of April, I can't exactly remember, they issued a letter saying, thank you for the balance sheet, thank you for that, but can you explain on bank account X, what is this 12 million rand that was lying there? It was actually, I was so cross when I got that stupid letter. It was very clear that he had a 12 million rand in his bank account with FNB, and he used Capitec, the old mercantile bank, to transfer his money out. So it was merely a transfer from one bank account to the other, because his tax return did correctly state that he had about 11.5 million rand on his balance sheet, 28th of February 2022. But anyway, so in the process, I had to ask him to get me a bank statement from FNB. Quite a complex. Sorry for the background noise. There's some alarm going off. But anyway, so he had to go back to FNB, and he had to get a from the archives a bank statement, because they didn't have proof of that. Then suddenly, when we went into his system on the 25th of April to upload that document, the FIA for that day was completely cancelled. So people who were in the process of FIAs and they have not yet submitted all their documents, the FIA was merely cancelled. So if you are sitting with a lot of FIAs that has not been approved, please go back into the system and see if it's lying there as under review or whether cancelled. If cancelled, go back and cancel, consider it as cancelled. You can do nothing, and reapply and make sure you have all the additional information you have. I've had long discussions via one of the RCBs with SARS, and they now agree that if someone has ordinarily has been tax resident, no longer ordinarily tax resident, then we can submit a letter saying we are not disclosing foreign assets. It's not required. From a colleague who's apparently spoken to very high up individuals at SARS, they say if he's been out of the country more than 3 years and he's been ordinarily no longer resident for 3 or more years, so that's the RA test, then they will accept that you don't need to give balance sheets. But if you are considered to be ordinarily no longer resident and it's in the last 3 years, they are not so convinced you're not coming back, and therefore they want balance sheets. And when I said to him, but how can they decide they're not so convinced you're not coming back? And this individual who spoke to the SARS official said they pointed to the fact that so many people who signed formal immigrations, that MP336, sworn affidavit, I will not come back for the next 5 years. Guess what? When COVID-19 happened, they all came back. So unfortunately, COVID-19 statistics has made it very clear to SARS that ordinarily no longer resident is not so long as we intended it to be, or they intended it to be. People easily state ordinarily no longer resident, but really when there's a world crisis, they run back to South Africa. Okay, so Dan, Stan, can you check if there's any questions again before I go to the next slide?
I don't see any questions.
Okay, right. So just to summarize on the AIT, the tender one disappeared, the foreign investment one disappeared, and the tax immigration one disappeared. But I want to discuss some practical implications, but I see that we've gone for about an hour. So we give about 5 minutes break and then we'll start again.
That should be fine.
Thank you.
Hello, everybody. I'm going to start with some of the questions I can see in the question box. There was a question from someone. Is given that you personally work in the UAE, that's correct. You are a PE as per DTA. No, I'm not. I don't work there as a employee of a South African company. Therefore, liable for CIT. Yes, I'm liable for CIT because I trade in my own name. Not as of 1 June. The tax law starts 1 June, but it's effective for tax year starting the first tax year starting after 1 June. My tax year in the UAE starts 1 January. So therefore, it's only 2024. I'm going to pay 9% tax. There is a 3 million dirham turnover exemption for small businesses. And I wish I was over 3 million dirham turnover. That's 15 million rands. So at the moment I have to file for tax returns, but I will not effectively pay current laws. Okay. But no, would I agree that I'm a PE? No, I am a registered business in the PE in UAE. So I am an ESR in their rules. PE in their rules is a foreign entity with a presence there. I am a UAE resident and I trade there in my own name. And my South African company is a CC. I'm not allowed to trade abroad. That's a Reserve Bank rule. Okay. Then Mohammed Kamdar asked, it's the same question. Okay. So that's that. Any other questions that I can't see? Okay.
Yeah, I didn't even see that question. It wasn't showing on my side, but I think we've done everything now.
Okay, right. I just want to quickly see how I get rid of this little thingy. Just a second. Okay. Right. I'm going to start up again on the TCS spin letter and the foreign investment allowance. So a lot of people are asking me, and this is not really new changes. I think it's just we don't always fully understand the impact of certain changes. You will remember that when we did when we did the formal immigration, once you did the formal immigration, every family could every year take 20 million rand out of South Africa without getting a tax clearance. That has disappeared. And you thereafter, from 1 March 2021, you had to do an FIA, foreign investment allowance, for all transfers. But now with the new AIT process, and also because of the changes that happened late in 2022, if you have done a tax immigration, okay, and I do understand some banks will, based on your bank letter of formal immigration, do it, but the manual says, if you have tax immigrated from South Africa, then your income post-immigration is freely remittable as long as the bank has an annual tax good standing. So on the current system, there's no more automatic 20 million, but your income from South Africa is remittable on a good standing. And there is a little subtle sentence that's saying, provided full tax compliance in South Africa, which means you sold a property, the withholding tax had to be paid. If it was a dividend, the dividends withholding tax have to be paid. If it was interest, the interest withholding tax had to be paid. But there's a caveat. The minute income for the calendar year, not a tax year, for the calendar year, because that's a Reserve Bank rule, goes over 10 million, then you have to do an AIT or the old FIA process. But for all capital transfers, you will always need to do the new AIT process. There's one other exemption. It has been there for a while, but not many banks are allowing it with ease, but fight until they allow you. Remember my example of my couple that are living in Australia? They're on an investor visa, okay? So they invested, I think, $750,000 Aus dollars, and they now are there as investors. Okay.
they have living annuities paid from them to them in South Africa, annual living annuities. Because they are not tax resident in terms of the treaty, they do not pay Australian tax on that retirement annuities. So there's no benefit in doing an exemption of pay-as-you-earn exemption. The RST01 application will fail. But the Reserve Bank will still allow them to remit that living annuity over and above all other allowances. Okay, it's over and above any other allowances. Okay, they can then take the living annuity net of tax out, provided they have a foreign address and a foreign bank account. So remember, this couple has not tax immigrated. They can therefore still, each of them, use their 1 million rand annual allowance. That gives them 2 million. They can still do their 10 million FIA. So the Reserve Bank still have the FIA. They just called FCA, Foreign Capital Allowance. Okay. And they can take their living annuity out. And quite interesting, what we have successfully achieved for the wife, she works for a South African publishing group, and she does proofreading or editing or something, but sitting in Australia, typical digital nomad. And the Reserve Bank has allowed us, or the employer, to pay her net of tax from the South African employer, the publishing company, directly to her bank account in Australia. Very interesting, and it's in the Reserve Bank rules, okay? So if you ever have a client like that, so what we had to do, which the Reserve Bank requested us, quick application, we went onto the SARS system, we did an IRP3Q application. Now that application, although it is a directive issued to the employer, only the one with the e-file profile of the employee can file for it. So it's a very interesting one, why it's lying under the employee's profile. The company could not do that. But that is now how things are standing. So me and Mr. Magnus's fight on LinkedIn is really just a storm and a cup of tea, because there is no retraction and there's no further exchange control restrictions, okay, because of the AIT process. There's one other restriction that came in on 23rd of May, and remember AIT dates from 24 April, and that's totally unrelated, and it's more an interpretation issue, but we'll get to that a little bit later. Okay, so now the TCS PIN letter is your only remaining option to get money out of the country if you have tax immigrated, and that's the AIT one. And you have to file it as either a resident, and then you must declare worldwide assets and liabilities, or as a non-resident, okay? And do not use the AIT until you have, as a non-resident, until you have done the immigration letter and it's issued. Because there's the copy of the letter. I've just hidden the tax number or the application number there. The reply my client got was the very next day, quick. Tax compliance status application declined. The South African Revenue Service has declined your application, TCS application, under reference and that was the AIT one, in respect of the approval for international transfer. So you can see it's a letter that was issued now, very recent. Your TCS application was declined due to the following reasons. The taxpayer must apply for non-residency status before the application the AIT application can be considered. Refer to that. Now, we have now replied and said, as I explained, that this client has a foreign Australian address, but in terms of the tax treaty, she cannot exit South Africa. She remains ordinarily and treaty resident. They came back very, very polite, and I thought it was very nice of them. They actually phoned me, in UAE, and they told me that they can't reopen the application. I unfortunately have to reapply and start a fresh application. So there's still teething problems with it, but please note that the sequence on now, my suggestion is VDP first, then RAV asking for the letter of immigration, then file your 2023 tax return. Those three can be done in sequence. You don't have to wait for any completion. But before you do the AIT application, wait until you have the immigration letter in hand. So what is the pink elephant in the room for my nemesis that always wants to sue me and get me interdicted to shut up? Tax immigration is the only way you get money out of the country. And there's now two distinct processes. In the year you leave, you only need to do the letter of immigration application, the so-called RAV01 process. Pay your exit tax, have the letter, it has no expiry date. Then you have to wait 3 years and 1 day, because you must be tax non-resident for 3 continuous tax years, and then you can ask for your retirement annuity to be encashed. Okay, so there is no more something like financial immigration. If someone advertises financial immigration to you, question the integrity of their tax knowledge. Okay. There are a few clients that have cash in South Africa. So let's use the example. Client has a property for 5 million, residential property. We do the tax immigration letter for their tax immigration during, say, July 2022. And we're now going to, as soon as we filed for it, we can commence the tax return for 2023. So until end of August, they're going to pay tax in South Africa on worldwide assets and the employment in South Africa. And from the 1st of September, they're only going to pay tax in South Africa on SA sourced income, which in terms of the treaty may be taxed here. That's dividends, withholding tax, interest, withholding tax, but some withholding tax, be careful. But we are waiting for that immigration letter, and the minute that is out, we are going to then ask permission to take the proceeds, the 5 million net of capital gains tax out of the country and take that out. So that AIT process is going to be in respect of 2024 year, and my letter of immigration is going to be in respect of the 2023 tax year. Can you guys see that SARS is now effectively split? The effective tax year of tax immigration, that's why you can backdate, to the tax year you take out. And then again, a big warning, when you're doing AIT applications, and we've seen them, and it's in respect of a property sold, because you now have to tick, you have to tell exactly what is your proceeds on disposal. When you say it's a property sold, make sure you provide everything that SARS may want to ask. And let me give you our experience, and it's only about a month old now, okay? They want the final statement by the attorney doing the property sale now, okay? And Afrikaans, afhandelingsstaat. They want the same final statement of the attorney when the property was bought to show what you paid as transfer duties. If that's not available, they will suffice with a transfer duty receipt and a deeds office text, the printout of the deeds office showing when your client bought the property, what was the registered purchase price, and then what date it was. If there's no transfer duty receipt available, they will not grant it to you. Also, do remind yourself of the fact that if there's an final statement from the attorney and he charged for bond registration, it's not often that the one doing the deeds office also does the bond registration, but it happened in my client's case. Bond registration is not capital gains tax because it's not a cost of acquiring the property, it's a cost of financing the property. So SARS did not allow that. Then we had to file the NR02. That is the document signed by the buyer, who is South African, saying he sold to a person non-resident. And the NR03, that was the directive we obtained from SARS, because obviously the 7.5% tax on turnover, so the gross disposable value or the proceeds, that's the amount that the withholding tax is calculated on, 7.5%. That was in our case very, very unfair, because this poor client was in the KZN area. And after the floods, floods and the riots, they sold for more than R1 million loss. Okay. And although it was remember, they went out in August, so they could get their primary residence exemption. But SARS insisted on a directive, which we did, and they then issued very quickly a null directive. So we had to submit that to the AIT team to show there is no provisional tax payable end of August, because they said to us they will allow the money, but they want proof that we have already paid the August provisional tax. Now, if that's so fair, I don't know if that's correct. It's not. I don't know if it's so fair. I did ask the lawyer to issue me a letter that he will hold adequate funds on trust account to pay the what you call it, CGT on the property. But then luckily, the reply or the SARS directive to make it a null return came out very quickly. So I can't tell you if the letter from the attorney to say that he'll keep the capital gains tax or the provisional tax due in August on his trust account will be accepted by SARS. But be aware, SARS is now in a risk management process. If they are not sure they're going to collect that tax because you're taking too much cash out of the country, be aware that the obligation is on you to guide your client to either pay in advance, okay, or to deal with it as a letter from the attorney if it will work. On speaking or discussing this with one of my fellow colleagues, the one who referred this client to me in KZN, a lady, she said to me she would not pay it as provisional tax. She will merely pay it as a advance payment, okay? And the reason why she prefers advance payment sounds very logic to me. I've not done it myself, but it sounds good. Because some of these properties being transferred now, the effective date of sale was actually in the February 2023 tax year. So although the afhandelingsstaat or the final statement is only dated in May somewhere or June somewhere, the actual transaction was signed and the transaction was final. The bond was granted to the buyer way back in February. So, and she is doing the income tax return for this client. She believes it belongs in the 2023 tax year. So she could have either paid it as a September, a third provisional tax payment, or you can do it as an advance payment. So for those of you who don't know, if SARS issues a directive to the attorney to say they want R1 million or 3% of the proceeds held back as a capital gains tax withholding tax, the attorney never pays as provisional tax pays. He always pays it as a third provisional top-up or advance payment, okay? So just be mindful, because otherwise, if it just pays it over as assessed tax, and there's no amount due as per the assessment, SARS are going to trigger a refund and an audit, okay? So now, if we now look at the AIT process and we look at the different processes, the first one is on the left-hand side, a resident person, okay? So you remember, and I'm patronizing a few people, but I just want to make sure that we all understand. When I do the AIT process since 24 April, when I'm dealing with a resident in green, it is worldwide tax, capital gains tax, income tax, deemed income. Then we can claim the 183 stroke plus 60-day exemption, the 1.525 million. And my client is subject to estate duty, so that's why it's worldwide assets. And there's donations tax. So if it's a donation, if the source of funds are between husband and wife, you still need to show the donation, but there's no donations tax payable. Also remember, on this annual, forget that word, on this lifetime cap of 20 on the first 30 million, donations between spouses seems not to add up to the 30 million. So the 30 million is made up of all donations during your lifetime on which donations tax were paid. So the 100,000 per year exemption, the donations between spouses, and the donations of assets you held before you came to South Africa do not add up to the 30 million cap before you start paying 25% donations tax. Okay. Then as an ex-con resident, because for Reserve Bank purposes, this person is an ex-con resident. And since January 2021 or Circular 1 of 2021, the Reserve Bank Circular, this resident can create a loop. So if you want to take money out of South Africa, put it into an offshore trust, an offshore trust then buys a South African company, the Reserve Bank finds it allowable. Some of the authorized banks will not allow it, but it's at this stage technically allowable in terms of Circular 1. Then you do AIT, whether the source of funds are income or capital. Now, just remember on that last item, if you are non-resident, you only do AIT on income in excess of 10 million Rand per calendar year, not per tax year. I'm now going to the right-hand side of the slide. Now I'm filing on behalf of a non-resident. I tick the very first question as non-resident. If you are no longer ordinarily resident, then your estate duty is reduced to the South African situs assets and the physical presence test. Now that's something that a very few people understand. Remember the rule that says if you're in the country for at least 91 days per tax year for 5 consecutive years, and then in the 6th year, you hit 91 days as well. But for the first 5 years, you had a total, an aggregate of 915 days, then you will be deemed a resident. Now that test can only apply to people who are ordinarily non-resident. So please go and check your clients who spent substantial time in South Africa during COVID times, because there's no exemption as the law stands for people that were locked into South Africa. And remember, don't just look at the hard lockdown days, that 63 days from March till May, June. Look at the time when people couldn't fly out of South Africa because Mauritius was locked in. I could not fly to Dubai because they didn't take any South Africans in unless you went 2 weeks to another country and stayed there for 2 weeks. But anyway, very important. It's nice to say I'm no longer ordinarily resident because my estate duty is only on South African assets. But the negative side is the physical present test now applies, and I must now check my days in South Africa. A double tax treaty person, okay, that is non-resident because of a double tax treaty, they do not need to count days in South Africa. The only time when they need to count days in South Africa is, for example, remember I'm Dubai, but say I had a company in Dubai that I worked for, then I can come and spend 180 days in South Africa working for the UAE company without paying tax in South Africa. But that's a 180-day test in any 12 months. How do you do that test? The day I arrive, I must do a calculation for the next 12 months forward and make sure that I was not in South Africa for more than 180 days. On every return trip, every time I leave South Africa, I must do a calculation for 12 months backwards to make sure that in the last 12 months, I was also not in South Africa for more than 180 days. If I indeed was in South Africa for more than 180 days, I get taxed in South Africa from day one, but on the source base. It doesn't change my tax residency. I now just pay tax in South Africa on source. So, for example, with me having my business in the UAE, I still pay tax in South Africa on a worldwide basis. I could not tax immigrate because my center of vital interest is still in South Africa. I have a house in South Africa and I have a rented apartment in Dubai. So there's no ways I could tax immigrate into the UAE. But it was also not important for me to get a foreign company. There could be any reason in any given year. In practical terms, in 21, my father died of cancer. I was in South Africa more than 183 days. Then I would have income and I would have had no tax credits. If I was working for a UK company and I lived in the UK and I paid UK tax, then I have a now SARS is going to tax me from.
Hold on, Hugo, you're breaking up for a second.
Okay, so I'm going to start with the UK. If I was working for a UK company and their test is 183 days, not 180 days, and I worked in South Africa for 183 days, 84 days, then SARS now had the right to tax me from day one, which they will do. I have not paid pay-as-you-earn, therefore I'm a deemed provisional taxpayer, and I must pay provisional tax. The UK will not switch off my pay-as-you-earn in the UK, and I must wait till assessment date to get that funds back. So unfortunately, the minute you have a PE in a foreign country, your risk of paying or cash flow for paying pay-as-you-earn twice until you have a refund is extremely difficult. So that's why I'm so worried about this PE establishment, in terms of a double tax treaty, when you're working in a foreign country and create a permanent establishment. Okay. So sometimes you must be brave like me and say, you know what, doesn't matter what tax planning I do, I'm not going to be able to create a PE in Dubai because there's no guarantee that I'm going to be employed there as from a South African company. My restriction, as I mentioned, is the Reserve Bank doesn't allow a CC to have a foreign branch. Yeah, I could have converted to an PTY and have an audit because foreign direct investment, South African companies that wants an investment or branch or a subsidiary in a foreign country need to have an audit. And I just looked at all the costs and decided, you know what, I'll just rather pay the tax. And then remember, I am a resident. So just quickly jumping back to the left-hand side, because I earned that income in the UAE in my personal name, okay, I invoice the client in dirhams. I do not qualify for 1.25 million. So I cannot claim that exemption. For the days that I spent, for example, traveling as a digital nomad now in Germany and the Netherlands and so on, where I'm not there 183 days, I'm not at risk of creating a PE. If those days altogether adds up to 183 days, and I have the 60 days out of the country whilst in employment, then on that part, I can claim the 1.25. But the 1.25 million must be for employment income. It's not there for everybody. Okay. So for example, so now just back to the case of a non-resident. So remember, I'm a resident, I fall into the left-hand side. But say your client works for, let's use South African brands that are in UAE, the groups like Yum, Tasha's, the restaurants, they're all there, and they physically work for that country, for that. And so the South African company transferred them off the payroll in South Africa onto the payroll in the UAE. Then that exemption, they don't need to worry about 1.25 million cap because they have tax immigrated. But SARS are continuously going to ask for their balance sheets on every tax return in the future. So this year, I see that they do not yet automatically trigger balance sheets. But remember, the Minister of Finance threat last year, the year before, February 21 budget speech, that he wants a balance sheet for everybody who is not auto-assessed. So therefore, there is this risk that we all have to file a balance sheet. But even if you're non-resident, if you are filing an AIT, you want your retirement annuities to go out or the proceeds on your property sale to go out, you are obliged to fill in a South African and a foreign balance sheet. And do note on the new AIT form, it's 2 separate balance sheets. And do note that, remember on the IT12, and I see those IT12s for 2023 that I've opened, the balance sheet for foreign assets still 1 line item, and the debt for foreign assets are still 1 line only. But the minute you fill in the AIT, it is a detailed balance sheet. They want bank account numbers. They want to know which bank. They want to know if you have an offshore trust. So it's a very detailed question. So I'll come back to my general advice. If you are now accepting a client, make sure that the mandate includes an obligation on the client to prepare an annual balance sheet on a worldwide basis splitting South African assets and foreign assets, and perhaps reconciling the growth, or allowing you to do it at a charge. I know it's going to make us a little bit uncompetitive against the, I call them the bos boekhouders, the unregistered tax practitioners. But I just fear that if we don't start getting our clients to keep balance sheets and reconcile growth, we're going to have a big problem. I can give you practical examples. I have a business where I help South Africans, specifically those going into the UAE, to transfer their first million without tax clearance, because it's SDA, single discretionary allowance. And we now find, and kid you not, remember UAE is on the grey list themselves, but the bank that side says, this bank account has just been opened. I don't know anything about you. I want the source of funds of this. Then we say to them, oh, it's after tax saving. Then they say, give me your tax assessment. Some clients are reluctant to give it, and some can give it, but the cash that they're sending over is more than their last salary, because remember, the IRP5 may be only for 3 months. They're going over in typically end of May. The clients are moment helping. They have a 3-month IRP5, and they're taking, they only earned 400,000 Rand, but they're taking over $1 million, husband and wife, it's 2 million. And then also interesting, just in the UAE, if the wife does not have a full spousal visa, she can't open a bank account of her own. So they take it out of South Africa as 2 different 1 millions, but in the UAE and UK, where there's joint bank accounts, they bank it into one bank account. And now they want to see source of funds of 2 million. You don't have an IRP or an assessment showing net after tax of 2 million. Now you have to dig through history and get proceeds of copies of the proceeds of the property sale. My client that now went beginning of June, luckily we still had evidence of the liquidation and distribution account of the husband's parents that died, and the wife's sister that died that she inherited from. Murphy's Law, all the L&Ds was in Afrikaans, 25,000 later, translated into English. And then when I sat in front of the bank, they said, oh, could you not do it for me in Arabic? Well, I nearly flipped, but anyway, convinced them to accept the English translation. So one of the side effects of grey listing we must not forget is the fact that we are now facing source of funds rules in foreign countries. We've only introduced source of fund rules now since grey listing in South Africa. Then very right-hand side, non-resident. In the
sorry,
Yes.
Hugo, you broke up for a second. Did you see the question about regarding earning a salary in the UK and getting taxed PAYE on a monthly basis to the UK exchequer? Does
Yeah.
income earned in an UK need to be declared in the SA return?
if you haven't tax re-immigrated, absolutely yes. And then you can claim the tax credit for the amounts above 1.25 million. So look at the interpretation note dealing with 6 quat now. It's escaped me, is it 134? I can't remember exactly what's on the interpretation notes number, but there is an interpretation note on 6 quat. And then if you also go to the SARS webpage, foreign earned income exemption. So right at the top, Google, foreign earned income exemption, there's a frequently asked question, and they give you the way how you have to portion that tax credit. So yes, you have to declare and you can get the tax credit. And remember, even if it's below 1.25 million, you have to declare and claim the exemption. So quickly back to the slide, just to repeat that, what I said there about the fact that when you are in a foreign country and you're there because of a double tax treaty, you must still continue maintain South African balance sheets because SARS is asking for that. And we now see that because of grey listing, foreign banks are asking for source of funds. And if you bank account that you just opened last week, it's not often that your payslip shows net after income of 2 million Rand. The other important part, whether you're non-resident on the ordinary basis or on the treaty basis, there's no donations tax because donations tax is within the Income Tax Act and only applies to residents. So there's some planning. If your client's going to be in a foreign country where he can't get a permanent residency, like he's in an American L1 or K1 visa holder, then or in Australia on a 457, and he now converts to a permanent residency permit, but he's still coming back to South Africa, use the no donations tax option and think about creating an offshore trust. Do remember, offshore trusts are always expensive to run, and the minute you withdraw money from that source are going to tax you once you are back. But very important, as a non-resident, need not worry about the 183/60-day exemption. But again, my advice to you is if your client is tax non-resident, do tick the block to open the container non-taxable income. It's under the complex wizard. Under the complex wizard, you then say non-taxable income. Top right-hand corner is any income that is exclusively taxed in a treaty country. And there I would aggregate my foreign salary and all the South African interest that I earned that is then taxed in that country only. Because it's very important. Our tax obligation is on a gross basis, then you must claim exemption. You can't just say no because the tax law says it's exempt or excluded. Then remember the old days, you changed your status at the Reserve Bank using MP336. That's no longer possible. Now you change your ex-con non-resident status using the tax letter from SARS saying that you have completed the tax immigration process. So it's quite interesting. There's a bit of a conundrum in there. The definition in the regulation still says a non-resident is someone who took up permanent residency in another country. But my clients in the UAE, although they can't get permanent residency permits, they get letters from SARS saying they tax non-resident. And the Reserve Bank then accepts that SARS letter and treats them as non-resident, which means the after-tax rental income that they receive in South Africa can be remitted without applying for an AIT approval, provided it's less than 10 million rands per calendar year. But I would love to have a client who receives 10 million rand in rental income. So all of our clients receiving rental income and living annuity can just remit their South African sourced income abroad based on the fact that they have proof of a foreign address and they have a foreign bank account. So what I'm saying, proof that you have a foreign bank account, you can only transfer from Yugo Rand account to Yugo Dirham or Yugo Pound. You can't now transfer that to your daughter studying in London and you are living in Australia. You unfortunately have to then, if you wanted to be in London so your daughter can access it while studying, you then have to open an account in London in your own name, or you must do the long way. Your South African bank transfers from Yugo Rand account to Yugo Aus dollar account. And from Yugo Aus dollar account, I then transfer to the pound sterling account of my student or child. A very longer process, but do take into account that some of the exchange control rules that remains extremely effective and well monitored in South Africa. Okay. Dan, I see there's another question came up. Do you want to quickly read it for me before I answer this one?
No, the questions I got was that one about the UK, and then I got your one that you had from Mohammed that I can't clear because you said you wanted to answer it.
Okay, sorry. Okay, I will answer it at the end of the seminar. So now at the moment, the biggest complaint about AIT TCS PIN by my named friends are the fact that once you now get the AIT PIN letter, the one page, a few line items, but the minute you enter the TCS detail online on e-file and you check it, guess what? SARS discloses the full balance sheet to the person opening the TCS PIN letter. Now, all that hoo-ha on LinkedIn and the press and the SARS that's a Reserve Bank clamped down. I don't believe a word of that. It cannot be a Copy Act contravention, because who are you giving that TCS PIN letter to? Anyone who gets that TCS PIN letter from you must only get it because they need it. And a bank, in terms of our Banking Act, needs that. Okay. So, for example, if you look at the balance sheet in front of you and you look at the right-hand side, so only after I captured the TCS PIN plus my client's tax number did I see that a transfer of 5.27 million. Now, all we can assume happened is that this community of property, and if you look at that fixed property that's on there, that's 1/2 of the fixed property. So we do think what they did is they doubled up property to show the full gross of that. Okay. And it was a very interesting case. In this case, the fixed property is not yet been sold. Okay. No, it's sold. It's technically sold. But the deeds office process has not been finalized because every time the guys submit the documents at the deeds office, there's some technical error on the mortgage registration or cancellation. So in this case, what happened is that when this lady bought the property, the name and the mortgage was in her maiden name. When they sold the property, the contract in the new surname, and now when they asked to cancel the bond, they did the cancellation in her married name and the deeds office threw it out. So this property, I have a letter from the bank, not the bank, the attorneys saying they are going to cash out roughly 5.27 million after the property is sold. And we think this is where SARS got this figure. So interesting is that both husband and wife each got an AIT for 5.2, where they actually asked jointly. So the system is not working correctly, but the arguments in the press at the moment that this is a I can't see why it's a copy act because they provided me with the TCS number. Plus, we provide this TCN number and me under permission from the client, authorization or power of attorney. We give it to the bank to get the money out. So the only people who have access to this is SARS, the taxpayer themselves, me as tax practitioner, and the bank. There is no confidentiality broken because the banks are now, because we are grey listed, forced to ask you for source of funds. So all I did is I sent a covering letter to the bank to say, source of funds are the property sales. So there you can see the property sheet at base cost, historical cost, and you have permission to take out 5 million. And here is the attorney's final statement showing he's going to transfer 5.2 million to their bank account or one of their bank accounts or both, I don't know. But there's the proof how we can reconcile it. And at this stage, the bank is happy. Obviously, the money has not flown yet because the deeds office transfer was not done. But two very, very important things I want to highlight. Is the one, as I mentioned, it seems like SARS will allow transfer on 2B banked cash, as long as you can show the transactions in the process. Because in this case, they asked us a copy of the marriage certificate. So obviously, what they looked at and what we submitted had two different surnames. And secondly, they did ask us for a capital gains tax calculation. Now, as I said earlier, this couple lost about R1 million in value from selling, and you can see there on the proceeds they're going to get, there's not much of a gain, and they've done improvements to the property as well, which brings the capital gains tax down as well. Furthermore, this fixed property, that 2.4 million, was what she had before she married him. So remember that that base cost becomes his base cost for his 1/2 of the property. The other thing that I want to point out to you guys is that they have not immigrated yet. They're in the process of immigration. So base cost was not an issue, and they have no listed or unlisted shares. I had two colleagues phoning me in the last week here in Europe We're annoyed because the balance sheet is overstated. SARS has overstated the balance sheet. And I said, send me the balance sheet, photographs on WhatsApp and so on. It's amazing. You can see all the issues. And knowing the client a little bit, because it's friends of mine, I said, no, SARS is technically correct. This client has tax immigrated. I did the tax immigration in the 2022 tax year. I helped them pay exit tax. Can't remember the exact figure, but for that client, their share with easy equities was close to 7 million rand. SARS is showing there a base cost of 7.5 million. So I assume that's the growth that took place in between. But that is indeed base cost. Remember, when you did an exit and you on that shares, there's a step up in base cost on fixed step up in base cost. But on unlisted shares and listed shares and certain stock and livestock, there could be a step up. But remember, if your stock or livestock was part of a permanent establishment, which remained up after immigration, then remember there's no exit tax on the assets used within a branch or used in South Africa. Obviously, motor vehicles, I don't know the specific family in front of me. 720 looks like their own little valuation. And I can see why SARS accepted it. They're not really that worried about cars because there's no capital gains tax on it. And in this case, I don't know the client, but 500,000, if you think this is half of it, to have R1 million personal effects, either the wife has a lot of jewelry or they have very modern or expensive furniture. But it seems like SARS are not unfair in the process. We are getting these applications through as quick as possible. Okay, so now we're nearly 2 hours in, and I'm now going to go to the exchange control, the last bit. We're nearly finished. So Dan, can we do another 5 minutes?
You can.
Thanks, Anil.
Tony, we're just doing a 5-minute break. We'll start to get in like another couple of minutes.
Okay, everybody, I'm going to slowly start. The next part is not so important for those that's ready. It's of value, but it's not part of the formal presentation, but quite interesting. I had someone who asked me privately, what is the address where we can find the Reserve Bank documents. It's there on the page. You can see it's a Rest Bank, not SARB, Rest Bank. And then on Rest Bank, you actually go to what we do. Then you go to financial surveillance. You see it becomes turquoise. And then you go down there to financial surveillance documents. Okay. Then when you click on financial surveillance documents, there's a few headings. The general control and regulations, okay, that was issued in 1961, okay, still applicable. They're there on that turquoise link. Just remember when in the regulation, it says this regulation applies from the first time it was regulated. That date is 1939. So just for interest sake, someone that has been born in South Africa since 1939 is deemed to be exchange control resident, okay? Or anyone who has lived in South Africa on a permanent residency or had an SAID number since 39 is deemed to be a South African exchange control resident. And therefore, the anomaly of that is someone with a Namibian passport who was born in Swakopmund is a South African exchange control resident. Okay. Then the orders and rules, that's a very few. There's one or two there, not that important. Then this one is your Bible. This is the currency and exchange manual for authorized dealers. Okay. There's one below for dealers in foreign currency with limited authorities, ADLA. Easier to read, but not so reliable. This is the best one. And the current one we'll see later when I show my screen to you, dated 23rd of May. So the exchanges we're going to discuss now comes back, dates only back to 23 May, unless the actual circular, and some in fact does, refer back to February 2022. Then there's the circulars, okay? And directives they're not really issuing anymore, but you have to click on the year and there does the circular appear, okay? So I'm going to just stop share for a second because I'm going to go back to my slide. So that is where you can get the circulars. Circulars from the Reserve Bank is no longer confidential or hidden. You don't have to beg your bank for it. Don't buy a bucket of a famous chicken brand, okay? You can get it online free. So first of all, we're going to go and start with the exchange control update. And we're going to start with the 2022 recap, including some of the 2021 changes. So in 2021, the circular 1 of 2021, okay, although it's called the loop rule circular, it also had rules dealing with donations. So as of 1 January 2021, if you as a South African inherited a foreign asset, you only needed to notify the Reserve Bank. It would probably be approved that you can retain the asset abroad, even if it was from your South African dad. So we call it a foreign asset in a local estate. You could now keep it abroad. You didn't need to go and beg and go on your knees to keep it there. Okay. Then in 2022, another circular came out, circular 7 of 2022. It's on the bottom part, I refer to it. And that one said, you no longer even need to notify. You are exempted from that notification obligation and regulation 7. And it said any person. When you then go to the Reserve Bank definition of a person, the Reserve Bank definition of a person included a trust. So now we had this anomaly that a South African trust could inherit a property in London and need not even tell the Reserve Bank. But then it could not operate a bank account because there's the exchange control rule that says a South African trust can't operate a foreign bank account. And also the foreign inheritance to a company, a South African company, could inherit a foreign asset, but companies, but not closed corporations, can operate foreign bank accounts. So there was an anomaly, and they have fixed that in the 2023 circular. Okay. But anyway, so the important part to remember is coming from 2021, we have this loop rule. So the loop rule as it stands at the moment, and we do anticipate changes on that one as well, probably backdated as well, is that current rule says when you create a loop, at the end of the transaction, you have to notify SARS. There was no, notify SARB, Reserve Bank. There was no requirement to do a prior application or approval. The only caveat or exclusion was if you bought shares in a South African company, but you also took over the loan account of the seller, then that loan account had to be pre-approved. Okay. So buying shares, you didn't need the approval. Buying a loan account that is subject to repayment, you had to notify SARS. Okay. So there's the 2021 circulars, nicely summarized for you. The first one is the loop rule ones, now allowed, still there, not for a South African trust. South African trust can't do a loop rule. Okay. Inheritance can be retained abroad, but must be placed on record. Circular 6 of 2021, also February 21, same day, eventually said now formal immigration, financial immigration, whatever you call it, is gone. The new rule is you must be 3 or more tax years non-resident to cash out your RA. And it has a provision that listed or unlisted shares can be immigrated. Okay. It's a funny word, but it's actually transferred as non-resident shares. So for example, if you have shares that's listed in South Africa, and you have a 10 million FIA, old days, now AIT, you can ask that company to transfer you to the share register in London. Okay. Then the very important one, and SARS did not like this, but SARB said a South African trust, Intervivos, and a Mortis Causa trust can distribute to any non-resident person, including a foreign trust. SARS immediately issued a press release and said, no, will not. one or two threats of constitutional court, and I think a lot of pressure from Treasury. If you look at the SARS webpage on trusts, very silently on 1 August 2022, they now allow for that, but it's a manual process. Circular 8 of 2021, now we're in May of 2021, says, with Circular 6 dealing with the post-immigration rules, we're now switching off your 1 million rand. You can no longer use 1 million rand because you take after your tax. You can take income up to 10 million rand out. You can take your living annuity out. And if you have assets to take out, you do use the FIA at that stage, FIA. Okay. It also unblocked all blocked accounts, blanket unblocked blocked accounts, including the so-called double blocks, those where there was the Inter Vivos trust. So to explain to people who can't remember, if you immigrated and you funded your trust, the assets and the trust was blocked. If you immigrated and the trust was funded by your father and he is still alive, then it was double blocked. You had to wait for your father to die before you could take the money out. Okay. Then Circular 10 is the post-immigration one. And that clearly said that you only need a TCS good standing once a year to take it out. And for assets, you needed a FIA. It had a very interesting rule that says trust can transfer out provided the trust obtains a TCS good standing. There was no requirement that there need to be proof that the beneficiary had to be non-resident. We'll see now later in 2023, it's now a requirement. SA employers can now pay salaries from a South African company to a employee abroad. Okay. And we no longer needed to do a FIA for that. But there was a caveat if it was a related party. So if you were the shareholder, and remember, related party, exchange control, and tax is not the same. If you had one share in that company, it's a related party. Or they say if you can influence it, so to your son's company, then it was not an automatic permission. Then you had to still do a Reserve Bank approval. But in all the cases, we got permission to remit the salaries from the South African company to the foreigner. The only requirement was that the salary must be agreed upon or be agreed in rand terms. Now, that's a little bit unfair because if you really want to expand, so it's not just someone who accidentally immigrated, but someone who really goes to London to go and expand the business, they need a dollar salary or pound salary to survive. And then 11 of 2021 said living annuities was now above SDA. So you could take your 1 million rand, so residents could take the 1 million rand per year, plus they could take their living annuity out of South Africa. So it was a very, very interesting exemption. Then in February 2022, much to everybody's surprise, came budget time. A lot of restrictions was lifted. And they said the retention of foreign gifts and other authorized foreign assets abroad was no longer reportable. Now, to give you an idea, if I as a South African inherited an asset from a foreign person who's never lived here, I could not leave that asset there. Sorry, if it was gifted to me, I couldn't leave it there. If it was inherited, so it was bequeathed to me, I could leave it there. So there was this total unfair treatment. Then it said all persons, including trusts, had this benefit, and Regulation 6 and 7 was specifically switched off. Now, Regulation 6 and 7 can be summarized as follows. 6 says, if I'm a South African and I receive any foreign money, it is deemed that I've made it available and sold it to the Reserve Bank or its agent, an authorized dealer. Regulation 7 said, if I received any asset other than cash, I could request permission to retain it abroad. And both of them have a clause that unless switched off by updated circulars. So Regulation 6 and 7 stands in a very hard reading government rules your life. And then there's in the circular clear guidance that they have lifted someone. The other one was, remember when we took our 10 million rand out, you could never give it to your son living in London or your son living in South Africa. Now, from February of 2022, so before the February 2022 year end, you could donate or advance to a South African person any foreign asset, provided there was full disclosure, including, and they just say SARS disclosure, that's IT 144. Circular 6 was a clampdown on credit and debit cards. It was always there, but it was just made very clear that you cannot use either a South African debit or credit card to do overseas gambling. All crypto assets could be bought. They didn't stop you buying crypto assets. You could do a what they call fiat to fiat. Now, I can't remember the abbreviation, but a South African registered bank is a fiat. But Luno in South Africa is not a fiat. Their fiat is Standard Bank. So you could still transfer from a South African fiat, Standard Bank, for example, to Standard Bank International, and that's a fiat. And from your Standard Bank International account, you could transfer it to your crypto account. That was allowed. But you could no longer buy cryptos using your South African debit or credit card, and then it gets credited to your crypto wallet. Okay, that's very important. Then Circular 8 of 22 at roughly the same time said, we could now take more than 10 million. So 10 million from that date onward is a glass ceiling. You can take now more than 10 million out of the country and you can freely invest. In the old days, they would on special application allow you to go over 10 million, but then only if you invested in your own name, and there was a clause at the end of it to say that that assets was still subject to exchange control, which means the day you die, your executor had to bring it back. That was all abolished in Circular 8 of 2022, and it still so remains. There's been no changes to that. Then Circular 11 of 2022 said a South African company can now increase its foreign direct investment to 5 billion rand. And on the old days, when it was 1 billion rand, it had to be in the same industry. Now it can be outside line of business, but it still had to be an active business. So you couldn't take 5 billion out to go and buy a residential house in a company. It had to be a trading company. And then branch profits can now be left abroad. So if you had a South African company and you created a branch in London, in the past, every 90 days or 183 days, depending on your specific approval, you had to bring the money back to South Africa. And then in Circular 11 said, now you can keep it there. Very nice allowance, because now we could use the rands to pay the tax, but we didn't need to bring the foreign currency in. And for those guys that are following the South African exchange rate, just to give you an idea, do remember that I do not have a branch of my South African company in Dubai because it's a CC. But when I started in Dubai in May of 2019, exchange rate was 3.65 rand to the dirham. It's not as high as that anymore, but when I left Dubai on the 1st of March, when I arrived in Dubai on the 1st of March of this year, it was 4.95, and when I left now 1st of June for Europe, it was 5.35 rand. So it's from 3.65 to 5.35 in less than 4 years. So that benefit we now have is really a wonderful way for companies to hedge against buying stock or produce in a foreign country. Circular 13 of 22 is a once-off dispensation for immigrants. So everybody who is financially immigrated, but they had a tax refund, or for any other reason had 100,000 rand left, as a once-off, and provided it's the last 100,000, not 100,000 per bank account, it is their last 100,000. They could then have that transferred to their foreign account without any approval. Now, it refers to formal immigrants, but we do now know that banks allow people with a letter of immigration to also apply this 100,000 rule, but they insist the bank account being closed. That's typically someone who wants to close their tax number as well, so they really want to close their footprint. Now, this why I make a point of highlighting this is if they bring in this new rule that we discussed right in the beginning, that they wanted to say South African trusts distributing income to a foreign or non-resident beneficiary will be taxed on it. And the Reserve Bank now says that that South African trust can pay to the London bank account, then that beneficiary no longer needs a bank account in South Africa. And I'm suggesting to the extent that that taxpayer still has a bank account in South Africa, close that down and use the 100,000 Rand to take the money out of the country. So 24th of April came the new AIT process. We've discussed that in detail. But then on 23rd of March, not totally as a surprise, again, we have seen that. I remember seeing in 91, the investment company 91, Investec and one or other two people's newsletter saying that this was about to be done. So the Reserve Bank changed this rule that anyone who has an inheritance from abroad could keep it there without reporting it. And they now restricted it to private individuals or trusts. Okay. Now, plus that they added the requirement that if you want to distribute from that trust, the South African trust, then you need a TCS process for the individual. We must show that the individual tax immigrated and or the beneficiary of the trust. Now, if that individual, if the beneficiary is not an individual, I assume they refer to an offshore trust. Now, I can't see why an offshore trust must come and register in South Africa. So that's a bit of a raise this through SICA's Exchange Control Committee, and we are awaiting an answer through that. Circular 5 of 2023, same date, says if you now have foreign debt, you can now early repay it without the Reserve Bank approval. Obviously, you must do it through your authorized dealer, but in the past, the authorized dealer had to go to the Reserve Bank because they didn't want a flight of capital. Now they feel so comfortable with the South African credit system that if you want to make an early repayment of foreign debt, you can do that. But Circular 6 of 2023 is the painful one. There's a total U-turn. South African trusts may no longer inherit foreign assets. You can't donate foreign assets. So bottom line is the South African trust may no longer own foreign assets. And although this was announced on the 23rd of May 23, B17 was withdrawn and replaced with rules effective from 22 February 2022. So there's sadly no indication what is the interim or transitional measures for trusts that did inherit assets or donations. So remember that loop structure. We had clients who physically put money into the offshore trusts, and specifically when they were older, say in their 60s or 70s. Because of the 30 million at 20% donations tax rule or 30 million inheritance at 20% and the rest at 25%. I had clients that had the situation that, you know, they're not terminally ill, but they have cancer. They know they're facing death in, say, the next 5 years. Therefore, they were happy to get their money out of the country. Remember that Circular 5 of last year said you can go over 10 million. It was a glass ceiling. Reserve Bank allowed them to send 30 million out of the country. They then donated that 30 million to an offshore trust, and they South Africa. That 30 million was then used by that foreign trust to buy foreign companies, and that trust then donated some of the shares in the foreign company, donated it to the South African company. Now you had a situation that 40% of the offshore company was owned by the South African company and 60% was owned by the foreign company. And this was not a tax scheme. It was a case, in that specific gentleman's case, 3 of his 5 children lived abroad, and therefore the offshore trust, and 2 of his children were in South Africa, and they had no intention to leave. So now suddenly that person is in contravention of exchange control because of a backdated rule. Okay. So I'm convinced under Regulation 7, we'll probably get the permission to do that, but we are now forced to do that rule because they didn't tell us what was the interim rule. And I'm sure that if we can show to them it was basic estate planning, he was happy to pay the donations tax because he would have paid the estate duty. And the only bit of saving really for him is that if he left everything until the date he died, then a certain part of his estate would have been, a bigger part would have been subject to 25% estate duty. So yes, there's somewhat of a tax saving for him, but then on the other hand, he's not terminally ill. He can still live with his type of cancer that's managed as a skin cancer. He can still live for the next 10 years. So SARS has the cash flow benefit of it. So I'm not too worried that it was too aggressive. And remember, Section 80, Cap G of the Income Tax Act says it's not a scheme, because the main reason why we did it was because 3 of his 5 children has left South Africa with no intention of coming back.
Before Hugh, you're going to probably do questions anyway. There was a question on the TC.
So welcome. So this is now the end of it. So let me quickly look at some questions. Okay. Which one have I not? Okay, that George's bylaws. I don't understand the question. No official immigration occurred or applied for. Maybe you dealt with it earlier. The anonymous attendee, the TCS requirements in May 20 has to register for tax, never a SA taxpayer, or does this mean the manual application? If manual, what information is required? So yes, there is still the possibility, if that person is a non-resident for tax, never lived. Regulation 7 says if you ever lived here, you're deemed resident. So this would be, for example, if you have a person that is a Frenchman and he owned a property in South Africa and he sold the property, he does not need to do the AIT. He can get his money out on a dip. We have to go to and prove that the tax was paid. That's one example. The other one is if he has shares in South Africa or cash in South Africa, then we must go back to the bank where he opened his bank account the first time. If certificate from them that he is classified as a foreign national, a foreign national with consent to bank in South Africa, then and he never lived here, then the rule says that that money can go out, provided that there's some evidence of how we collected it. For example, a property sold, or we had a share investment in South Africa. Not the easiest of processes, but it is indeed possible. In many of those taxpayers' cases, because they pay dividends tax and all things like that, it is sometimes better to do a tax number and do it that way. But the other one that I want to give an example, which I don't know if Anonymous intended that one, there's also a Reserve Bank rule now that says if you inherit up to 10 million from a South African estate and you have tax immigrated or never lived in South Africa and you are inactive on the tax system in South Africa, then you can have that funds transferred from the executor's account to your foreign account. The only time we see the bank saying no is the case where there's property. So you inherited a fixed residential property and there was the withholding tax from that. But for the rest, it is possible. It's very unique cases. I can't remember of others, but I'm sure there could be other cases. But it's indeed possible. And as a general rule, I prefer not to register those persons as taxpayers. But there's indeed a manual process. There's a manual process for inheritances, appearances. There's a manual process for trust-to-trust distributions. And I have recently had one of someone that was born outside South Africa, and he inherited many years back from his grandparents. The executor opened the bank account in his name, and because he was a minor, his mother had signatory, and his mother has since passed on. We gave all that evidence, and it's not evidence on hand. Gave that to the Reserve Bank, and the Reserve Bank said, let the money go. I just had one this morning, which I think is extremely unique. It's a person from Zimbabwe that worked for South Africa but he always worked in
You're breaking up there,
Angola.
Hugo.
Okay, that last one is a client who worked for a South African company, Zimbabwean, but he stayed and lived and worked in Angola since he was 19, 20 years old. And now the pension fund paid out, and the withholding tax was quite high, 500,000 on 2.5 million. But the Reserve Bank allowed us to send that money out because this tax number. But now, sadly, because of the 500,000 as you earned deducted, it created a tax number. But at the time we did the Reserve Bank application for him to cash out his pension, he had no tax number. We had a letter from SARS that he was never registered, and the Reserve Bank allowed that to go out. Again, a very unique case. Any other questions?
There was a further comment to the previous one about the immigrated before they earned income and don't have a bank account. And then there's another question. Currently earning a salary in the UK and get taxed PAYE on a monthly basis to the UK exchequer.
Okay.
I think we've asked this one before, but let's just check. Does
Yeah,
income
that was George's, the one I didn't understand. So I'll answer now. Just on the anonymous one, immigrated before they earned income, don't have a bank account in South Africa. Unfortunately, that person has to now reactivate their tax number. They have to then open a bank account. It can be remotely done. Most of these new Forex agencies can do that for you, and one or two of the bigger banks. But if you earned income in South Africa, okay, and you were in South Africa before, I'm sorry, you have to get a tax clearance to get it out, because remember, single discretionary allowance no longer applies. So George, on your case, currently earning a salary in the UK and get tax pay as you earn on monthly basis on the UK exchequer. Does income earned in the UK need to be declared in South Africa? Yes, if he has not tax immigrated. No, if he has tax immigrated. If he was, yes, he tax immigrated. No, he has not immigrated, then you can claim the 1.25 million exemption. The UK tax rates, unless you're a very, very high earner at that 51% bracket, they pay less than us. So you're going to top up in South Africa. But remember, in the UK, if he lives in the UK, he works in the UK, his family's in the UK, and his only house is in the UK, he became a UK resident on the 92nd day in the UK. So he should just do his tax immigration.
Let's see, there's something underneath. There's a further thing from the anonymous.
For beneficiaries, yeah, okay. So anonymous said, I refer to the beneficiaries of the trust. No, unfortunately, if they were South Africans, you have to do a, they have to register for tax, and you need to get that tax immigration letter. I am told some people have been able to get tax immigration letters without recreating a tax number or reactivating a tax number. I'm glad for them. I just don't know how practically to do it, because to trigger the request for a immigration letter is an RAV process, which means you must have an e-file. The minute you have an e-file, you have a tax number. So in my case, if it's a South African with an ID number or someone who lived here before, I would think that you'll have to tax register and get the tax immigration letter, sadly for you, okay? If it's a person who has never lived in South Africa, you do a sworn affidavit and you do a manual application, the same as you would have done for the one on trusts, okay? It's a manual application. And it's all by email. You don't have to. And then when they ask the supporting documents, they create a case number and you upload it through the SARS tool system. You can't email the supporting documents to contact us. You have to, unfortunately, use the SARS tool system to upload. But they can create case numbers without tax numbers.
Okay, so if there's no more questions, I'd like to thank Hugo for your time. Very thorough, in-depth discussion, and very informative. Thank you everyone for attending. The next webinar is on the 6th of July. That's Jackie Aronson on the mid-year tax update. And for today's seminar, your certificates of attendance will be emailed to you within the next couple of days. And again, thank you. And tonight's the longest night, as I said earlier. So have a good night's sleep. And because the days will start getting longer and the nights shorter. So thank you again, and thanks for attending, and good night.
Thank you. And again, apologies for the sound. And Danny and Stan, if there's, I'm quite happy to, after the 11th of July, to do at least the basic important stuff, a recording, and send it to you for the guys. Okay. Because I apologize for the sound.
Right. I think if they email Danny, then Danny will forward it to them.
Thank you so much.
Yeah, it could sometimes also just be the interference that your the wire of the microphone picks up.
Okay, I see.
So it's not actually even the signal. It just could be the radio frequency.
A loose connection. So yeah.
Yeah.
Yeah,
Okay.
somewhere there.
Okay. But thanks a million. And I really appreciate the invite, guys. And as you can see, this is absolutely my passion. So if the guys want to raise questions through you, I'm quite happy to help.
Yeah. If anyone else wants to, I'll send it on.
Thanks a million. Good day to
Cheers,
everyone.
thanks,
Bye.
everyone.
Bye.